Major funding for this program is made possible by grants from HSH Nordbank, New York branch, and First American Title Insurance Company of New York, Perfect Building Maintenance, Greenberg Traurig LP, the Moynihan Group. Additional funding for this program is made possible by grants from Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, Cushman and Wakefield, Fremont Investment and Loan, Massey Knackle Realty Services, Rosenthal and Rosenthal Inc., Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Witkoff Group, Titan Capital, YL Real Estate Developers.
Welcome to the Stoller Report. My name is Michael Stoller. $31 billion of sales in New York and investment sales of commercial, retail, multifamily apartments in New York City this year. $31 billion, and that doesn't even take into consideration the other $14 billion or more because of these REITs going privatized. Rents going to $150, $200 a foot for commercial buildings. Hotel rooms selling for $1.2 million. What's happening? Are we in a bubble? Where are we going? I don't know. That's why I assembled 6 of the leading real estate gurus to tell us a little bit of where they see 2007. My guests today include Lee Nybart, Senior Partner, Apollo Real Estate Advisors. Barden Gale, ABP Investments Managing Director. Marty Cohn, Co-Chairman of Cohn & Steers. My buddy over here who came here from Hamburg, Germany today. Global Head of Real Estate Financing, Global Head of Real Estate, HSH Nordbank, Bernard Fisker. Chairman of the Board of BRT Realty, Fred Gould. And last but not least, not a small company either, what's his name? Jeff Barkley, Managing Director of ING Clarion. You know, I have apples all the time, but I don't have a crystal ball. I mean, maybe the apple is like a crystal ball. Where do we see, you know, no one ever expected $31 billion. No one expected Stuyvesant Town, Peter Cooper Village to trade for $5.4 billion. Nobody expected hotels like the W in Union Square to trade for $1.1 million per room. Arden, where do you see the market? How high can it go? What's going to happen next year?
I thought you were going to ask Lee the question first.
No.
Damn.
He may be sitting over here, but it depends on who I try.
Well, listen, you know, if we're talking about New York, that's one thing.
We're talking tri-state.
Well, let's just step back a little about the whole real estate market. I think, you know, there's only so much return in the market, and that goes even beyond the real estate market, stock market, bond market. There's only so much return there. And real estate's been very fortunate to have gotten more than its fair share over the last few years. And New York in particular has gotten more than its fair share. So, you know, just for real estate going forward, you know, just to throw a number out, we're seeing for the vast majority of real estate, at least in the United States, you know, high single-digit returns going forward. Now, I'd even apply that to the REIT market, although I'd defer to Marty. As far as New York City, that's causing everyone's, you know, to scratch their heads because, you know, New York doesn't just compete with L.A. or Chicago or Columbus, Ohio. It's a global marketplace. You know, you're competing for office tenants with London, with Frankfurt, with Hong Kong. You're competing all around the world. Paris, right? So, and you know, given this era of fluidity of capital, of fluidity of communications, whether it's electronic or otherwise, and fluidity of workforce, you know, you've got a more interesting dynamic, and I think New York, candidly, stacks up pretty well on a cost basis for commercial real estate. So if you're paying $200 a foot for Midtown London, doesn't 85, 90 bucks a foot sound kind of cheap here in New York. As far as housing, again, the dollar's weak. I mean, we're looking pretty good for, some of the most desirable real estate on the planet. And as far as retail, as long as the dollar's cheap, this is a global town, and, we just have to go walk in Times Square on any day of the year and count how many languages we're hearing. So I think New York does have some upside, but it's certainly not coming from cap rate compression or increases in sales per square foot. It's coming from, increased revenue on the commercial side. If any place.
Marty?
Well, also real estate, while New York competes with London, and money in New York competes with money in London and Hong Kong and Shanghai and all around the world. So money around the world is looking for a home where it can get the best return. And if you look at the U.S. Treasury market, if you look at the bond market, even if you look at the junk bond market, the returns do not meet anyone's liability if you're a pension plan or an endowment. So you've got to go where the best returns are. You may only get high single, low double-digit returns from real estate. That's still better than most other asset classes, including hedge funds, by the way, which have the most abysmal, they've attracted the most money and had the most abysmal returns. Real estate can do a lot better than that.
I think to answer it another way, there's two interesting leases that have occurred or will occur, and that's the Bank of America lease in the Durst Tower and the MetLife lease in the Verizon building, assuming that goes through. And what we're seeing now are companies that we've all grown up with, banks and insurance companies, who would never pay rents that were equal to or over the market, now have no problem paying those rents. In addition, and if you add law firms into that, you're seeing that these major companies able to pay rents have no problem paying $100 a foot in rent for these prime locations.
Why is that?
Because they think that they have to be able to do business and attract people. And now you have a situation where MetLife is in Long Island City, is unable to attract the workforce that they want to in order to make them a more profitable company. My point is that I still think you have a lot of that mark-to-market, or the ability of these tenants to pay more in rent, which I think will only drive these rents higher, which means that I think that values will continue to increase.
If you focus on New York City, new product in New York City was practically non-existent throughout the 90s because it didn't make economic sense. And then the condo craze came along and land was priced out for office. So the deliveries of office to New York City as a percentage of the stock is nothing.
It's nothing.
So I think the MetLifes of the world, the Bank of Americas of the world, are trying to secure a position in a place where they know they have to be.
But there are other companies in New York City. I mean,
Indeed.
not everyone can afford this rent. Not everybody's a hedge fund. Not everyone's a financial services company. What about the working companies? What about a building recently traded, 2 Park Avenue, sold for $465 million. It's reported that a financial services company is going to buy it 2 months later for $570 million. It's on Park Avenue. It's Park Avenue. It's really Park Avenue South, 1 block away from Park Avenue South. Fred, you've owned property in that neighborhood. You got tenants paying $30 a foot. How can these tenants pay these increased rents?
I don't think that's a New York phenomenon.
No.
You have the phenomenon of large portfolios of office buildings being purchased and immediately being resold in Washington, D.C. and California. I think it's part of the national real estate market.
But I think my question is, how do people, companies, not everybody is like Goldman Sachs that they're giving away these bonuses. Companies have to pay rents. I mean, Bernhard, when your company, when you were at 590, you were at 590 Madison Avenue, and now the New York operation is much larger. You had to make a financial commitment, and you moved into 230 Park.
230 Park, Helmsley Building. And basically, we did a great deal on that thing from our perspective. It was a time where the TIs were great, a great location. You cannot duplicate that location, certainly. And we had the urge of the need that we had to expand. And I'm not telling you a secret. We still need more space in that building, and right now we're negotiating for another floor plan. And why is that? Because our business came strong. We view, and Barton, I share your view. When you talk about New York, and especially in Manhattan, you have to talk about other global alternatives. And yes, you're right. Basically, no inventory came over the last few years, massive inventory into the market. When you just compare, I was in Shanghai, and over the last 5 years in Shanghai, it was more skyscrapers were built there than in the last 60 years in New York. But from the outside perspective, New York is still in real estate one of the major capitals of the world. And that's where everybody wants to be. That's where we do our business. We just opened a rep office, an office in San Francisco, doing great there. But our first move was into New York, and business is still strong.
I think, Michael, you have to, you ask, the question you ask is, can they afford it? And the answer is clearly yes. I mean, if you just take a look at I was reading about the revenues per partner in these law firms. We just look at Goldman Sachs about to hand out how many billion in bonuses, right? I did some corporate real estate in a previous life. I mean, rent was either number 2 or number 3, and you said it was going to be X or Y% of your total revenues. It's like the operating ratios in a shopping mall. You know, how much of rent can a retailer's revenues be? And you're in the comfortable affordability, operating ratios for businesses. Why? One, their incomes are up, but their productivity is way up. The amount of space per employee is way down. The accounting firms, the number of people who need assigned places is way down. So the risk of people getting caught short with space is much more draconian than carrying a little bit of extra space. So, when I was with Salomon Brothers, and, when we did the original deal at Seven World, and we were, moaning about, geez, should we take this one extra floor? And boy, it took back then, this is, 15 years ago, 20, it took a lot, Now, I think they take 3 extra floors, just put them away and say, you know what, if I ever need them, at least I got them, because that's nothing to me.
And what's remarkable about that statement, which is absolutely right, is that the investor market looks at a major law firm and says, I'll pay the same cap rate for that law firm's lease as I will for Microsoft. And there's no knocking down of the value, whether it's a Weil Gotshal or a Skadden Arps, because these are billion-dollar revenue companies, all with very good balance sheets. And that's been a big change in how the city of New York, because years ago, those buildings that had the majority of the space leased by law firms did not trade at the same cap rates as those that were leased by industrial companies. That's been thrown out the window.
But we're not really, we're talking Manhattan, but we're also talking, Fred's office is in Great Neck, and you've been there for years in that location. You, in a prior life, spent many years up in Westchester, where the rents 20 years ago were $30 a foot. They're still $30 a foot. So the market is a little different. I mean,
that's only somewhat accurate. We had our office buildings in Long Island were flat for an extended period of time. Expenses were going up. Rents weren't. But the value of the buildings was still going up, even though the cash flow was going down. Now that's been abated. We're starting to get incremental rents in Long Island now in all our office buildings. Because I think it goes back to your original question. And I think your original question concerned, will people keep buying single-digit returns in real property? And you were quoting that or asking about it in 2007. And I think maybe the question should have been more than 2007 or longer than 2007, because we spoke about just, and we were in the other room, it's a different world who's investing in real estate today. It's become a future investment business, not a current return business. when a person buys a building today, he doesn't buy it for its present value. He buys it for what he perceives the value is going to be in 5 years. That's a change in posture for a real estate investor. Real estate was never like that. The stock market was like that. We spoke about that a while ago. If you bought a share of General Electric, you bought it today anticipating to sell it later for more money. Real estate is bought and sold exactly the same way today. No longer a current business.
But real estate's cash flows. Oh, sorry. Go ahead.
Would you say it's fair to say, or agree that it's fair to say, that basically it's not a question of real estate investments anymore? It's just a capital allocation.
It's an investment. Period.
It's an investment.
I accept that. Thank you.
And there are
and Marty, you know, you're the king of REIT investments.
Exactly right.
So what do you see?
Just another investment.
Well, you know, you've had repricing of property. You've had a repricing of REITs. And I think we revert to a, you know, high single, low double-digit return, which is still very adequate. I don't see any, you know, sometimes we talk about, you know, real estate people don't like other investors coming in because they kind of muddy the water, they overprice things, they call it investments, they don't call it real estate. The fact is, it is a commodity. And it's a commodity today that's in short supply in the island of Manhattan. If you want 50 or 100,000 square feet, it's very hard to find it where you want to be.
We can go to Jersey City. You like a REIT who owns a lot of real estate in Jersey City?
There are businesses that are good for Jersey City or Westchester or Long Island, but the reason that rents have stayed flat in Westchester and Long Island is because no one wants to be there. And those
so you're saying nobody wants to work in...
Everyone wants to be in Greenwich.
That's right. Greenwich, the rent's at $90
just like Manhattan.
Right.
But Marty, you know, one reason that real estate is now a commodity, and it never used to be. In the old days, it wasn't a commodity. It was a very separate type of investment. But the public markets have made it so. The CMBS market has made it so.
Right.
The CDO market today has made it so. And the REIT market has made it so. Now there's so much information and so much transparency, and it may lead to misleading investments or poor investments, but at least people think they know what they get. A lot more than they used to.
It isn't necessarily a poor investment. What's happened to the industry, an inefficient business became efficient.
Exactly.
When it was inefficient, we made a lot of money because the risk-reward ratio was better than it ought to be. The risk you took gave you a better reward than that risk did in other investments. When there weren't that many people buying real estate.
You had private information.
Exactly right. So you went out and only you studied the information about the building. You made a judgment because there weren't 50 people trying to buy the same property. What happened, the efficiency started on the debt side. When I was a kid, I bought my first home. Elaine and I bought a home. It was $30,000. I went to the Bushwick Savings Bank. They told me what my mortgage was. They told me what my interest rate was. And I said, thank you, and where do I sign? Now, you told a kid today who was buying a house, go to the Bushwick Savings Bank. Well, most of those don't exist anymore, but you tell them you go to the bank, and that's where you get your mortgage. They think you were crazy. Is that true or false? He'd think you were nuts, right? Because first they made an efficiency in the debt side in the single-family homes. Then they made efficiency in the debt side in multi. Then they made efficiencies in the debt side in commercial. And now there's efficiencies in the equity side because there's so many people desirous of being in what Byrd correctly calls that investment. And so that's a threshold change.
Statement is real estate becomes a commodity. I observe that too. Financing becomes a commodity too.
Finance is an unbelievable commodity.
Yeah.
There's so much money out there.
So much money, so much liquidity on both sides of the equation out there in the market. But what does it make to market cycles?
Well, you were saying is that shorten the market cycle?
Maybe.
This is the longest cycle I've been in business since 1960 something. I've never seen a cycle like this.
So what do you think? Do you think it's because of this efficiency?
I think a great deal is because of the efficiency. The risk-reward ratio is finite now. Everybody's in the business. Everybody wants to be in real estate just as they wanted to be in any other investment. He's 100% right. It's just an investment today. All the pension funds are in it. Look at God bless what you've done in your history in life. There was no REIT market. When you began, how many REITs were there?
Well, when we started our company, when I started doing this, was about $3 billion in REITs. down from 10 billion because they had all, you know,
Now what is
blown
it?
up.
What?
when we started our own company, it was 6 billion, and now it's 400 billion.
So-
And that's
so-
U.S.
And
And
that's
that's
got to go.
U.S. and it's
but
a
that-
trillion
that-
if you add non-U.S.
But that money has to go someplace, and when it went into real estate. So
Right,
that's why
right.
there's lots of money in it. It caused the,
Right.
That's caused the efficiency.
Now,
But-
while I say real estate is a commodity, what real estate produces is a commodity too, and that's an income stream. And that's what's being valued today. And that's why in that low return environment, the 4.5% 10-year or 30-year treasury and the 6% junk bond, that income stream, if it's from a credit tenant, whether it's a very good law firm or from a high-end retailer or what have you, you're basically buying a bond based on the credit, but it also has upside.
Mike, you know what you're saying? If you don't mind my saying, just putting real estate is a funny kind of a business. But it's been going this way for years and years and years, and it changed. There's been a major threshold
Structural
change. We don't see real estate is a service business. Nobody will believe that, but we're a service business. We present a box. If the guy doesn't need the box to make a television program, or a box to live in, or a box to have his office, we have no use. We're strictly a service. We have no use in and of itself in the industry. We present a box for somebody to do something in. So when there's nobody who wants your boxes because the economy tails, we're in deep trouble.
Well,
And that's another thing that's been forgotten.
I think that's almost the way I was going to answer it. I mean, we are very lucky in our industry, and we should recognize it. I mean, we are in the 12th or 13th year of this amazing bull market. And you have to remember back to the 87, 88, 89, 90, where major pension funds made major investments and lost major money. And they stayed out of that market for 4, 5, 6, 7 years. Now, they have had an incredible run like all of us, and until that event happens, whether it's a downturn in the economy, it's tenants going bankrupt, or interest rates go up, there's no major event for this money to stop from investing in real estate, because the major pension funds and the major investors have no stop signs in front of them.
We have the #2 pension in the world.
I thought it was number one.
No,
He just slipped.
it's
It's
just
old.
right number
It used to
two.
be.
Oh, yeah.
Another major pension over here. We have major REITs. People, you have advisors. These pensions are looking for a specific return. I heard Barton say and Marty say that returns are under 10%. These pensions are looking for a higher return, aren't they?
Not at all.
No.
No?
They can't get it anywhere else. And this is on a risk-adjusted
the
basis. They
alternative?
view the returns from real estate, especially from quality real estate, as very competitive, and they've continued to. As we said before, there was a dearth of construction in New York. There was also a dearth of investment during the early '90s, mid '90s, and meanwhile, these plans picked up a lot of contributions and didn't have a way to diversify. And now they're seeing the benefits of adding 5-10% to their allocation to real estate. And that there's a long wave ahead.
Now-
2,
now,
3
Remember,
all
there's
of
no
it.
fixed income that they can buy. You can take a multi-trillion-dollar market, and it's not available
Right.
to them because the returns are
So,
just too low.
people want to know. Okay, we've gone this. So where do you invest? What's the real estate that we should invest in the tri-state area? I mean, I hear Barkley over here who said you should definitely invest in office buildings, and he sold. He was an investor in the New York Times building. He sold the building. Why'd you sell the building?
Well, we
the
not
rents
only-
are going up. Everything's going there. Why'd you sell?
We not
Bernhard, you sold 17. You sold an office building. You've sold things. Why are you selling? So where do you invest? What's the market today?
We sold our share of the New York Times building back to our partner, to Forest City Ratner, at a point when we thought we had made the expected return for the risk that we were taking. We agreed to do that in 2001, right after 9/11. And we looked out into the future and said, if we hit this kind of return, we're happy.
So
And that's what motivated
my
us.
question is, where does somebody invest? What's the best market? What's the worst market? Is it retail? I think Barton Marty may have made the subject before about, multifamily is dangerous today.
Michael, where you invest depends upon whose money you have and the longevity that you have that money. See, if you believe that real estate's a future market, and it's your money, and you're not mourning somebody else's money, then you invest in something that you perceive will give you the best return over an elongated period. If you have to give a guy a return in 5 years or 3 years or meet the quarterlies of REITs, it's a different situation. If you ask what we bought a building last year in 11th Avenue and 26th Street at a very modest return because it's leased to the city of New York, and we're one of the few people who delighted to have the city of New York rent. I know people don't like it. We have a lot of it. Why? Because their lease runs for a finite period of time. It's in an area in New York which has been just booming for different usage than they're in. So we would kiss them to leave. Follow me? So we're sitting with a finite, modest return for a period of time. Then we feel that it'll be worth a hell of a lot more for a completely changed usage. Now, we can do that because we don't have to meet a quarterly earnings FFO report as a public company. Am I being clear? Our public company, which my son runs, is a debt company, not an equity company. And so they can more realistically forecast their earnings. But you ask where you have it. Now, if you're running pension money, how long is your pension fund in for?
It varies. There's open-end funds, closed-end funds. So there's a wide range of investment criteria and return thresholds. But I think Manhattan is still a very strong investment.
I have two specific lenders over here. Okay, you use your own money. You use your own money plus the stockholders' money, and you use money from investors. Where are you lending money today? What segments do you really like? What in the tri-state? Let's leave Manhattan. You know, there's Brooklyn. You know, there's the Bronx.
I still would like to go back to the original question. What is there? Because I want to hear this.
Yeah,
okay? It's like, what are people buying today, and why? Okay. And by the way, a couple of these guys spend my money for me, so I'm kind of curious as to what
I think you think about where you are in the cycle, and it's a very simple principle. At the bottom of the cycle, you want short-term leases, the shortest term possible. At the top of the cycle, you want the longest leases possible. Now, where are we in the cycle? We've had unprecedented...
Which cycle? The capital cycle or the income cycle?
I'm talking about the real estate cycle, let's call it.
All right.
I don't know. I'm not sure there is a real estate cycle per se.
Unfortunately, the tenants just think the opposite way. But
right. But if we are at the, we're well into an economic recovery. We're well into a stock market recovery. We're well into a real estate recovery. So I think you start buying property that has longer-term leases because that's your insurance policy against something changing.
But that's office. What about, you know...
No, I say that's office. It's not rental apartments. Because if things turn on rental apartments, you now have a vacancy or a rental rate problem. And that happens very quickly.
One person said to me a number of years ago on my show, I would prefer to own a rental apartment building because if one tenant moves out, I just lose one tenant. If I have an office building and I lose a major tenant, I have to rent the whole building. I mean, there's different points.
And it's cheaper to paint and carpet than to put in a TI installation for a new tenant.
I can tell you, Mike, 8 years ago, we started to buy ground floor retail condominiums when everybody didn't like it. Everybody didn't understand it was simply real estate with a little bit of a wrinkle. So we bought a lot of ground floor retail. We have a lot of we just bought from the developer or from the owner just the ground floor retail. Theory being, we're not that smart people. If there was a 2-story building there, now there's a 22-story building, there's more people with money in their jeans who are going to buy something in the street. Now, can we tell you, as Marty says, what's the rent going to be on that every year for 25 or 30 years? The answer is no. But I can tell you people will buy something there because there's a big building next to it, and they're building another building next to it, and another building next to that. So we found that buying that was similar to giving you a long-term lease because someone's going to rent that location because there's just so many bodies in the street. I don't know if that's being too simplistic.
I mean, our strategy is really, and we do a lot of work with Barden, is to buy things that we can also do some work on. And, we're not buying Fifth Avenue apartments that are leased, have Fifth Avenue office buildings that are leased for 20 years. So we're buying an awful lot of residential apartments where we can do new kitchens, new baths, new lobbies, new hallways, new facades, just making it better, because we believe that they're under-rented and that the market rent will increase dramatically in that type of an investment. So our story is not cap rate compression. It's not buying it at 5 and expecting to flip it at 4 or 3, which is okay if it happens, but it has to be something that we can go to work on and fix. And I think that where we may be heading for trouble is that's not the investment thesis of some of the market. Some of the market has bought at 7, sold at 5 without doing any work, made a ton of money, but that is not sustainable. And our strategy is to really just go to work on these types of investments.
But don't you think that a lot of things that you just said is already factored in the sales price and the price tag?
Yes.
As Fred pointed out.
Yes, but
so it's quite hard to actually realize that premium you want to get in return.
I think what Lee is referring to, I want to respond to Marty, because it's a real conundrum we're in, is there's stability. What we're investing in together has incredible stability of income stream. I mean, Jeff knows this stream. The three of us tried to buy Stuyvesant, and the reason we were aggressive on it is because the underlying rental stream, truly, one tenant to leave, another one would replace them the next day. I mean, that stream was inflation protected. Okay, so on the downside risk was very, very low on that, and I think that's what Lee's pointing out to on the rental apartment. I think generically New York City rental apartments have very limited risk, and there's a lot of analysis to support that. I think when we're asking, well, where should we invest, you also have to ask what's available to invest in. And unfortunately, offices is really what's on offer in New York. I mean, unless you want to go down, and I don't think any of us is qualified to talk about, investing in 1 or 2 families, or, spec buying some condos to hold. I'm not talking the buildings. I'm talking about individual units, to flip them or hold them as investments, which I think is probably pretty dangerous. But it's offices and big multifamily. That's really.
But there is a limited amount of retail.
It's limited.
But it's in small batches.
It's small batches.
I think that was one of the big appeals to many people of Peter Cooper Village, was that you could really get a lot of money invested in a very sound investment.
Let me just address Marty's question, because I want to bounce it back to especially the two of you and you as well. It's do you buy vacancy today in New York, or do you buy it long term? Because I saw, where Boston Properties sold Times Square for. I mean, that was a fully leased building. What was the economic cap rate? So take NOI, throw out a CapEx reserve, which could be pretty low. What's the economic cap rate of that thing?
Had to be less than 4.
Less than 4, okay.
Like 3.5 max.
3.5. So there's negative leverage on the thing, and you're not going to get any rent bumps. So you had to believe that at the end of 10, 15 years, where rents had to be, right? So it's a 10, 15-year bet about rental growth, and a lot of stuff happens over 10 or 15 years, right? And that's a big bet in New York.
But part of the situation is that there is so much money out there. So,
but you're not getting paid during that.
No, yeah. I'm not disagreeing. But some lender or some conduit or some securitization said, "Fine, I don't worry. I'll package it. I'll be the bookmaker. I'll syndicate it, and that's all."
Mike, one terrorist bomb changes, and maybe there's a 10% chance. One terrorist bomb changes a lot of people's thinking.
How about interest rates spiked 300 basis points?
We learn to live with it.
You learn to live with it, but it'll change the thinking of individuals. I'm not saying we don't live with it, but it's part of your equation of risk. It has to be. If you don't think it is any part of your equation of risk, that's not smart. You have to have. Maybe it's a 1% chance, maybe you think it's 10%, maybe you think it's so-and-so, but it is some equation of risk.
So let me just finish my thought, which is I'm going to go back to what Lee said. I think I'm a buyer of vacancy today, and I'm a buyer of short-term problems today, okay? Whether it's, you got a problem building that isn't renting because bad management, it needs a complete gut, it needs its core reorg, is something. What you buy in New York today that I think is still okay priced is stuff that needs hands-on brain damage kind of work, and then you can make more than a fair return.
Our most recent investment is with Taconic Partners, who you all know, down in Chelsea, near 111 8th. and it's a complete redo of an old building. Out goes a retail, in comes a new national retailer, and it's going to be very successful. And it required
Right near Marty's son's development.
It required a lot of cleverness to go figure that one out, and to kind of deserves the credit for that. But you know, if you buy vacancy, that's one thing. If you buy occupancy, in most office buildings we've held in our portfolios, I don't know what the percentage, I don't want to make one up, but a less than 50% number of tenants stay till the actual end of their leases. And that's one of the things in office buildings we've found, that with active portfolio management, they outgrow it or they have to leave or whatever reason. So sometimes you're getting it both ways. You're getting paid, you're getting a rent, and then you get your vacancy before you expect.
But the Times Square sale is a fascinating example of what's happening. Here's a private investor who bought it. And I don't know what the equity check was. Let's say it's $100 or $200 million of equity, and it's a negative arbitrage deal, no return for 5 years, 8 years, 10 years. My only point is it's a deal a pension fund would make. So in theory, if it was only a pension fund in normal times that would make that investment, the entire market has now changed with the wealth effect of all of these private individuals who are buying these buildings because in their own asset allocation story, they're in stocks, bonds, private equity, real estate, and they can afford to have no return in return for a pop down the road.
You know, this relates specifically, you know, let's look at 666. 666 is selling for $1,000 a foot, but you really have to you have to cut out the pieces, and I think, you know, that's something that people aren't really, you know, they say $1,200 a foot.
Right.
There's a retail component, there's a sign component, and then there's an office component. The retail component has been built out. It can't be expanded. You know, it's like the GM building. He's already expanded his retail component. There's no more retail. You can go on Fifth Avenue over there.
Second story?
They've already, possibly.
That's very true.
Right. Yeah. Right, no. So, you know.
Banks are on second stories all over there.
Right, but the idea is that was, you know, a property that's traded. How, you know, why did a guy like Charlie Cushman buy this property?
Because what the buzz has been in the last few days is that the market rents of that 85,000 square feet of retail space are astronomically high at numbers that I didn't even imagine existed. And that is a play that someone is willing to undertake, not us.
Because you have to wait.
You either have to wait or you have to buy the tenants out. And the fact that there are tenants that exist today that can pay in excess of $1,000, $1,200 a foot for retail rents, and that their business can support it, or their brand wants to be on one of the premier locations in the world, this is all new information. It's just developing daily, not yearly.
Even since the leasing of Warner Center and the retail there?
Yes. Yeah, absolutely. I mean, our retail shops have performed far better than we ever imagined. But 666 is quite a location.
I mean, your company owns 717, which, you know, you owned it a couple years ago. You made your profit, you sold it, someone else bought it, and then the interesting thing is they did a similar. They broke it down. Part of it was bought by Equity Office, and the retail was purchased by a group of New York families. They paid approximately $176 million for the retail component, which was, as you said, Barton, on the second and third floors. That property was traded this year, 2 years later, for $276 million. Retail is very hot in New York City. Vornado just made an investment at Manhattan Mall. Part of it was retail, but part of it's also air rights. And, you know, there are a variety of situations. But, you know, where is the market?
No, more interesting was when Vornado bought that strip on Madison, what was it? Like,
Right.
You know,
Madison
the hotel, the
65th,
South
the
River.
Westbury.
And it was this $7,000 a foot, which sounds really cheap today.
That's right.
How bizarre
Was
is
it
that?
545th that Vornado bought 10 years ago?
Yeah, with Heine.
And
That was
a smart deal.
And Vornado recently purchased 350 Park Avenue. And 350 Park Avenue needs a lot of work. And we've heard that Vornado, when you ask them what they're going to do, they don't like talking publicly, but they have spoken in front of certain panels, and you know that you've been on, I've been on, and they've said maybe we'll just rip it down. You know, here's a building. You know, where else can you get a square block in such a great neighborhood? You know, your building, Marty. I mean, the boys from Dubai are buying.
You know what? They made a good deal, turns out, because the rents there, I think unlike the Times Square building, I think the rents are really rolling very quickly there and doubling. So they're, when they pro forma, and it's a great location, when they pro forma the next 5 years, what looked like a very rich price is going to be pretty good.
Well, Dubai also bought our office building.
It's the Istamar building now.
280 Park Avenue, I know it.
Yeah.
In fact, we're in the same building, and I hope we're not competing for the same expansion space. But at the time, we thought we knew the building as well as anybody. We occupy several floors, ING, and we couldn't make the numbers work. And in hindsight, of course, it was a good deal.
So where do we, what about this hospitality? I mentioned that the W Hotel, the former German insurance company, then they changed the name to the Guardian Insurance Company, was sold for $1.2 million a room. I mean, people can, you know, travelers could move in, but not everybody can pay $700 a night.
Well, I would guess you would have to assume that that is above replacement cost, so you will see new hotels. I mean, it's that simple. We're a partner in the Mandarin, and the Mandarin will finish this year at a $817 rate. And
you say that, but we're not in the business of buying or selling individual assets, but you know, we have a relationship with somebody, and you know, in the hotel business, a very strong one. And somebody came to us who's putting together a fund, and one of their seed assets was a development site. And we said, "Oh man, this would be a great hotel site." He said, "Well, we don't know if a hotel can work." I said, "Well, we'll send it to, you know, well, trust me, we'll send it to the best investor in hotels, right, that we know." And these guys aren't operators, meaning they're not Marriott, you know, they're not Sheraton, they're not, you know, they don't have a brand of their, they just invest in hotels subject to management agreements. So this is a great site. He says, "That is a great site. We won't be able to make the numbers work. Do me a favor, take a look at it. 4 or 5 star hotel, this has got to work." You know, a lot of, came back, numbers aren't working. And they said, notwithstanding what the W did, all right, these guys own 6 major hotels here in the city.
you may be right. But New York City is awfully tight on hotel rooms, so it will be interesting.
Well, I'd also like to know in these, like, what's the food and beverage? What's the bar, the ground floor? What are some of the services they provide?
In New York
But
City, the problem, and then I'll let Bernhard, you don't want the food and beverage because the unions on a 4-star hotel, the smaller hotels are not caught with the union. When you're paying a dishwasher $13 an hour in a union hotel, and then you're paying 35% in benefits, you can't afford it. Restaurants do not make money in hotels, in 4 or 5-star hotels in New York. There's a need for catering facilities, but the restaurants are not a profit maker, except for maybe, you know.
Well, that's probably changing now, too, if it's done the right way.
Well, we've got Central Park views, maybe.
Right, it helps.
Yeah.
That Central Park views on the 35th floor for the restaurant. You were saying.
But you know, the equation of paying 1.2 million per key is quite simple. Basically, 1,000 you got to have as a room rate per night. So you basically you're at 1,200. If you have very strong food and beverage returns, then you can lower it maybe to 900, up the most. Do you get $900 per night?
You would get 450 pounds in London, but you wouldn't get 900 in New York.
Yeah.
You know, you were on a panel with me a couple weeks ago, and we were talking about different asset classes. So we've spoken about retail, we've spoken about hotels. You were on the same panel, and we were talking about assisted living. And I you know, in assisted living and active adult communities. I'm going to get to your comment in a second. No, I'm not going to let you give the comment. But
I
Fred,
like that one.
but Fred,
You're not scouting the map for
no,
yourself.
no.
He's
you know,
calling me because I'm closest to apparently to that age.
But in Long Island, there are these numerous two types. There's the active adult community, which is the 55 and over, and then there's the assisted living. Assisted living was very boom, and then it really went into trouble. Where do you see that? You've lent money on that, and you've been,
Demographics lead you to believe it's going to be a terrific business. Marriott went into it. A lot of people went into the business, but it isn't real estate. It's a business.
It is a business.
And that's the difference. This is a business. This is not investing, as Bert says, in real estate. Someone's got to run that business successfully. You built the box for somebody, and you gave the box to a guy in the assisted living business. He better operate that box successfully in his business.
it's like a hotel.
No,
I don't
no.
think it's like a hotel at all.
Hotel is also, in my view, not real estate, but it is a business,
business,
running
yeah.
a business. And I couldn't agree more, Fred. And therefore, we, for example, we don't focus too much on just assisted living, because it is one segment in the senior housing industry. The most successful concepts basically continue elderly people through their last phase of their lifetime in all aspects, and that is how you run the business, and not only focusing on assisted living. And the demographics in the U.S. are great, and unlike in other countries, and people are willing to pay for a good life when they reach a certain age, and they have the liquidity on hand.
We don't have a culture of children taking care of parents.
Indeed.
We don't have that culture in America. We have a culture of hiring somebody to take care of parents when you have the money. I'm not bragging about it. That's a culture.
We have a
Just
culture these days of parents taking care of children
That's
even
true.
after they left the
When
home.
your
So that's what's
parents
scaring
get
me.
elderly, parenting is a one-way street. We all understand that. But when your parents get elderly, our culture is not that you take them into your home and take care of them. Whether that's good or bad, I'm not making a value judgment. So we have to have a depository.
But that's,
And just to add on that, Fred, and
Did
also
you just say
the
depository?
Yeah,
That's exactly what it is.
Very human.
I was hoping you'd let it go.
You don't think that's true?
If I did,
It's
I
making me
wouldn't
look
say
good.
And also, the elderly people don't want to move, for example, from A to B. They don't want to. They want to be in their
Right.
basically in their community, because
Exactly
it's
right.
where they have their friends, and so
there's a-
they say, why should I fly to or move in with
Exactly what's happening.
my kids in Arizona? I'm here in Florida. I'm happy with it, and I'm content.
Jeff?
There's a bit of a hybrid, which is, I think, called the age-restricted communities, which is much less
Right, that's the active
service-oriented,
adult, as they
active
say.
adult, and it's sort of a glorified residential. And we have an Australian affiliate, speaking of capital, ING Community Living Fund based in Sydney, who's making an investment in a portfolio of just these kind of age-restricted properties on Long Island. And they did a tremendous demographic study, and they have a partner out of Canada whom they have a joint venture with, who've done a lot of acquisitions with them. And we'll see. We haven't done that kind of investment ourselves, except in California, but they're very enthusiastic about it.
You know, I haven't broached the subject of the condo market in New York. The other day, I think it was in yesterday's Wall Street Journal, Bob Toll was talking about, you know, how come you're coming into New York City, you're building, and I know, Fred, you're close with Bob, you know, the condo market. Where do you see the condo market? Forget your Time Warner Center or forget 15 Central Park. Where do you see the condo market in general in the New York area?
It's probably going through a short-term lull. We're involved in a project with Claret on the Upper West Side, which we're very enthusiastic about. It'll be delivered probably in about a year to year and a half. And if you underwrote it not to have to achieve stratospheric prices, I think you do okay.
Arden?
Well, I hope it's plummeting because I may want to buy one next year. But no, I'm along with Jeff. I think you're going to see some sensitivity along the high end. You know, the mispriced high end. I mean, if you're on CPW, I mean, so we're talking about new build.
Right.
We're talking about the new build stuff. I think you got to be really careful. I think you know, the really big money is not going to be, you know, going to the more frontiering or pioneering locations. I think I agree with Jeff. I think, you know, if you're going to be coming out, if that's the one on West End, yeah, I think by the time you come out, I mean, you got to ask what the Fed's going to do on this one, because I think, you know, we are going to be interest rate sensitive on this, and you know, I don't know if this is a good bet, but I think the odds are in favor of a little easing in the second half of '07. I think more than in favor of it. So I don't see a huge dislocation in it, but I do see, you know, you were discussing earlier, the bigger threat is the loss of the 421A benefits for benefit of the developer, which may ironically lead to a slowdown in starts, and therefore, you know, support pricing, you know, for people who are already in. You know, already in.
Yeah. I think if you look at the condo market, New York will be the last one to suffer.
Manhattan or
Manhattan. I mean,
there's a lot of projects planned for Williamsburg,
right? But
and other parts of Brooklyn.
But I've been spending a lot of time in Los Angeles, and you can just sense and feel and walk that the values that these condominiums and home prices came out of are really tumbling. Why? Because you don't have the infrastructure of the investment banks, the law firms, the accountants, all the hedge funds, the private equity world that you have in Manhattan supporting these prices.
You also don't have the zero down lending.
Okay.
Right? So you don't have these units coming back onto the market in distress, you know, dragging down the rest of the market.
So I just think that Manhattan, if it does level off, which I'm assuming it will have a very soft landing, because there still seems to now be those 20-somethings, 30-somethings who can afford to pay these prices. But I would be very concerned with condominiums outside of the New York metropolitan area in these other cities.
Bob Toll is not only coming into Manhattan. He has only one Manhattan project. He has two in Williamsburg. He has about four, one in the Gowanus, which is not even zoned.
One in Hoboken.
One in Hoboken. He has a number of...
He wants size, too. When Bob bought the old theater on 3rd Avenue between 13th and 14th, he called the office one day and said, "What can I get for a retail location?" We happen to own a building across the street, so my son had just rented it, so I could tell him what we got there. But he's making that area much more successful. It's a big building for that area. And that was the last lousy block on 3rd Avenue. It's not lousy anymore.
No.
NYU is south, and all of it is good. North.
Right, but both of you are lenders, and I've seen some of the deals that you've recently lent. You've lent up in Harlem on land and other, you know, and you've lent. I mean, you know, not every neighborhood is going to sell overnight.
Well, my son Jeff runs that business, and he's much more enthusiastic than I am, and he ought to be, because he's young. But what he does, as you mentioned previously, if we had to eat it, we'll eat it, because our equity side can take care of it. So we sort of wash the used car before we sell it. We don't foreclose and run away. We foreclose and fix it. And what I'm believing now is that if you have to foreclose on dirt, you'll live through the down cycle. But every cycle I've seen in my life, the next up cycle, the high has surpassed the last high. So if you can hang around, you're going to be okay.
Lower Manhattan. We really haven't spoken about it. You've never really invested there. I don't know if APB has. I mean, what's the opinion of Lower Manhattan?
My own feeling is that the office buildings and the condominiums and retail will do very well. I just think it's inevitable that those firms that can't compete for office space in Midtown will choose downtown as the next best choice, as opposed to Long Island, Westchester, Connecticut, or New Jersey, because you're still able to attract the workforce from New Jersey and Long Island on a very simple mass transit story. So I think now Lower Manhattan will be fine. I can't judge. You know, historically, when the World Trade Centers were built, they destroyed Lower Manhattan office buildings. Hopefully, this time they will be staged and done properly so as not to have that same effect.
I'd like to ask a question. All right, apropos of this, I have my own, I guess, personal view. I don't know if it's well formed enough to be an opinion. You know, we got limited capital to create infrastructure, right? You know, and the big projects that have been discussed have been, you know, an LIR connection going into downtown, or bringing grants, the Westchester trains down to downtown, or bringing the 7 line across Midtown. I think those are kind of like the three major huge options, all right, to adding. And the question is, you know, which one of those is going to be money best spent, right? And I think this really does impact your view on downtown, because I think standing alone downtown is probably better off as, you know, with, you know, following the trend it always has, which is increased residential. It happens to be a great residential. It's missing a park, which my personal view.
No, there is a park.
Yes.
If you go to Battery Park.
No, great. It's got a nice little pocket park,
It's very
right?
small.
It's missing, a couple of more green spaces, you know, more toward the center, right? But other than that, it's got all the waterfront, it's got transportation anywhere you want to go, easy access everywhere, great for residential, great views, you know, and all of that stuff. But I guess you're asking, I think it's got a future for residential development. The question is, I think bigger question is, for the big bucks, is where's the future for office development? And it's either going to be Midtown West, or it's going to be downtown. I mean, they're not mutually exclusive, but where do you think the money's best spent?
And you got about 22 seconds, because that's what I
don't think I know enough about downtown, but I think Midtown West is going to continue to grow. It's just a natural extension, and that was the bet we made on the New York Times Tower, and I think it's only going to get better.
It's hard to believe, but 58 minutes have passed, and I think we've been able to capture a good grasp of where a lot of money and a lot of people who are leaders in the real estate industry see the market in 2007. I'd like to thank Lee Neibart,
Thank you, Michael.
Barton Gale, Marty Cohn, Bernard Visker, Fred Gould, and Jeff Barkley. And I hope that, my crystal ball tells me what the real number is going to be. Thank you, and I'll see you next month.
Major funding for this program is made possible by grants from HSH Nordbank, New York branch, and First American Title Insurance Company of New York, Perfect Building Maintenance, Greenberg Traurig LP, the Moynihan Group. Additional funding for this program is made possible by grants from Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, Cushman and Wakefield, Fremont Investment and Loan, Massey Knackle Realty Services, Rosenthal and Rosenthal Inc., Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Witkoff Group, Titan Capital, YL Real Estate Developers.